Is the possibility of US default too much of a reality for markets to handle? Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, we welcome back Branko, who wrote the article today talking about this topic. It's not the first time we've mentioned the debt ceiling in the last week or so, but he really dug into it quite deeply today, and I thought it was quite eye-opening, a couple of those key graphs and statistics that were brought up. So welcome back, Branko.
Thanks for having me back, Chris.
Lots in there today. Let's dive straight in. What are you seeing as probably the assets that are not pricing in this debt ceiling crisis? Because you mentioned in the article that really, I think the number was something like 4%. I've heard this number going around. That's how much is priced in, about a 4% chance. People don't really believe that the debt ceiling crisis won't be resolved or that we won't end up with the sides agreeing. But that's maybe right, maybe not. But either way, what are you seeing as not pricing it in?
Yeah, firstly, I think the key point actually is, it might be a 3 or 4% chance, which sounds small, but when we compare this to the previous debt crises, which we put up on screen, that's actually quite a significant chance. And 3 or 4% sounds, like I said, small, but like it's a 3 or 4% chance of like having something at least as bad as the Great Recession, which is like genuinely like if the US government, if it's a 3% chance the US government defaulting on debt, like that's just an absolute catastrophe. So even though, and I agree with this, the government's going to most likely sort it out. It's going to be fine. There is that very small chance of just an extraordinary event, and its magnitude, it's kind of hard to price in because we all don't think it's going to happen. And that isn't being reflected in the assets, mainly equities, which is, holding up. You think it's risk, it's an asset that performs well kind of in riskier conditions. So you would think in a time like this, it'd be going down, but they're still holding strong. And then also gold, we're really not seeing that upside swing, which I want to get into more now.
Yeah, sure. So I'll ask you about gold, but I just think it's so bizarre, really, that explanation you just gave, where the market doesn't believe. So you've got the politicians coming out constantly and saying, one side, the Democrats won't talk, the Republicans won't talk. They keep attacking each other, saying something that no one believes, right? Like that fascinates me. We don't really believe. We believe it's all theater. We believe it's all not real, that they'll just come together at the end and solve it because, like, rightly so, we believe that because that's what's happened over and over again in the past. But isn't that just bizarre to really think that we have people telling us one thing and we all go, yeah, but obviously that's not true. And we try and look past it. We don't even believe the words they're saying. Because if we believe the words they were saying, the risk would be much higher than 3 or 4%, surely.
Yeah, I mean, Janet Yellen is screaming from the rooftops right now, saying just like we need to come to a deal, or it's going to be an absolute disaster. And we're not paying as much attention as we should. And if you had asked me a week ago, I would have been a bit more like it's going to be okay, and I still do think that. But given the lack of like strides towards a solution, like for example, Biden actually cancelled his visit to Australia today because he has to sort this whole thing out. So obviously it had stopped being easy, and in the event it isn't being sorted out, then it's catastrophic.
So how's gold? Let's bring it back to that gold question because I'm dying to know your thoughts on this. How is gold reacting? Like I would argue it's not really being, I mean, it's certainly at those all-time highs, but it hasn't really broken out on any. Is it not breaking through because it's waiting to see what actually happens? What's your take on it?
Yeah, I think it's interesting because it's been hovering around 3,000 for a couple of weeks since this um, debt ceiling stuff has been really kind of in the news cycle. We're not really seeing, a big move to the upside, which you would expect because there was a poll recently done that showed like what retail investors and institutional investors would do in the event of a default, and basically like half of people were like, "I would only buy gold. This is the number one asset. Like I would go all in on gold." And you know that kind of an event would be just great for gold. Everyone would jump in. We know that. And, again, given that people don't believe it's going to happen, we're not really seeing that movement in gold. And the upside in gold is probably like as high as it's ever been because we have this potential just looming event that could happen. And I think we have people that are kind of the doomsdayers. They've already positioned themselves like for an event like this to happen. And the mainstream media, the mainstream people haven't really um, positioned themselves correctly. They're still kind of in denial. And again, they're probably going to be right, but in that event where it doesn't happen, they're going to be in strife.
And the risk reward, it's an excellent analogy because the risk reward is just huge. That if when you look at that graph, I thought that graph was fascinating. That's where people rush to. So overnight, if that happens and they don't get an agreement and something,
Oh yeah,
it escalates, we're just going to see it flat out busy at Ainsley because you have everyone coming in to buy gold. But if you knew, like in hindsight, we'll be going, oh, we should have bought insurance before the house burned down. But it's one of those situations where you're going, well, we're in the middle of fire season, kids are outside playing with sparks. Maybe we should ensure we're insured up. Really, that's what you're saying, isn't it? Like,
yeah. And meanwhile, people are like, oh, the kids always play with sparks. They always sort it out. It's going to be fine. You know what I mean? Like the people think a solution's nearing, so they're not preparing themselves. And I mean, the risk reward is a great point because if you think about it from a trading perspective, realistically, gold's at the same level it was prior to this whole kind of crisis. So,
well, that's a really good point because it's not like we think if the debt crisis is resolved that gold's suddenly going to plummet.
Yeah, exactly.
It seems like a pretty good way to insure against this particular situation.
I mean, the risk reward is like 10 to 1, 20 to 1, because in the event, like I said, not much movement will probably happen to the downside, maybe a little bit, but hardly any. And then in the small chance it does, it's going to be all-time highs. I mean, people aren't factoring that.
Yeah, absolutely. So there was other things in your article of assets that are actually pricing in catastrophe to some degree. Can you talk a little bit more about those? Because I thought that was interesting as well.
Yeah, so credit default swaps, which I talked about that, 3 to 4% chance earlier, they're the ones that are pricing that in of US default. So those spreads continue to widen. And then also treasury bills, we're seeing a big increase in the basis points being offered on T-bills that expire closer to X date, which like X date refers to the date at which America basically has no money.
And Yellen's saying that could be as soon as the 1st of June, isn't she?
Yeah. I saw a prediction that's 1st or 2nd of June. So I mean that's 2 weeks away. And those treasury bills have just like spiked up. So they're pricing it in. But again, equities, gold especially aren't pricing it in really at all.
So there's still opportunity there, which is the point you're making.
Yeah.
So what about the banks? So there was a mention of JP Morgan and Jamie Dimon in the article today. And that is quite interesting because regardless of what you think about those big banks, and I know Jamie Dimon can be quite a controversial figure at times, but we probably do need to pay attention to what they're doing because the argument would be if they're taking it seriously, firstly, why? Because they would have at least as much, if not, you would like to think more information than we do about risks, and they'd have whole teams working on this. So I'm quite interested for you to maybe dig in a little bit on what those big banks are doing, why they're doing it, and what the sort of ramifications are for us as individuals.
Yeah, so I think the key point here is, Jamie Dimon, CEO of JP Morgan Chase, the biggest bank in the US, is basically having these weekly war rooms right now. And he talked about this in Bloomberg with other top bankers where he's talking about what to do in the event of US default. So he's talking about things like collateral, clearinghouse, like how everything would function. And, there's like a saying in trading where it's like, follow the big money. What are the institutions doing? Let's try and do what they're doing. And I think on like a personal level, if we see all these big top bankers preparing for an event like that, maybe we should also potentially prepare as well, just in some capacity. Not saying necessarily buy gold. I think gold is a good option, but just keeping it in the back of the mind that even though it's likely that it's all going to be okay, these very smart, intelligent people are giving it a lot of thought in the event it doesn't.
I think that's an excellent summary because it has been starting to play on my mind about the risk just not being properly factored into the markets, and we've seen other events in history. I can think of more recent years when oil went negative. We had that sort of big oil movement. Things that were impossible happened. Where you went, it can't do that. It can't go negative, and sure enough, it went negative, and the markets all scrambled and carried on. And even the last, when you think about Trump in the election, right? When he first came into office, there was so much uncertainty, and that can't happen, that won't happen. And then when it did happen, the markets just went crazy. So there's always opportunities when the bulk of the market has not factored in something that ends up happening.
An interesting point about that is I remember trading on the day that I think it was, I remember just hearing about the day Trump got elected, and the market, because it was an unexpected outcome, the market plummeted and was shocked, and then it actually rallied like crazy.
Yes, yeah, it made it all back.
Yeah, and it was an unexpected turn to the situation. So these unexpected things do happen. Similarly with COVID in March 2020,
Absolutely.
It was like panic, like disaster. People were freaking out, and rightfully so. And then a year later, markets are an all-time high, and markets are doing very well. So just always expect the unexpected, and that's
well, at least insure for it, because you can. Like in this situation, we're saying it's a low risk option.
Yeah, exactly. Probably not. Don't expect the US to default, but just it's more of an option than the majority would think at the moment.
Yeah, it makes a lot of sense. Well, thanks as always, Branko. Appreciate all that today, and there was a little bit of hope in there, which is a little bit off brand for you, but we like
it. Better than usual.
No, I really appreciate it. Thank you.
Thanks, Chris.
Thanks for everyone for watching. Remember, reach out on those with those questions or comments on the social platforms. We'll get back to you on those whenever we see them. That's us for today. In planning on being back here tomorrow, hopefully with Sam again, to talk about some interesting things he's been looking at. So stay tuned for that one. I'll see you back there then. Until then, stay safe, everyone, and I'll talk to you later.